Welcome to Global Financial Engineering. I am Dr. Glen Brown. In this session, I want to look at the GBP versus the Japanese yen currency pair. That's the British pound versus the Japanese yen. One of the objectives of this session is to provide you with a visual aid to show you why you should not trade via emotion. To show you that you should be consistent with whatever trading plan you decide to use. Hence, before you sign off on a trading plan, you must have some reasonable assurance that it suits your personality and you will obey the rules. But before we head over to the session, as usual, it's important to bring to your attention the general risk warning. What I'm going to do here is to put the risk warning on screen for a moment. You could pause the video if you are watching the recorded version and read the information on screen. Also, for those persons who want to have a clear guide where to locate the risk warning, you can go to our search, select risk warning. When you do that, you will see the search result. You click on this risk warning and the page will appear. So yes, you can go to the source where we update these risk warning on a regular basis. So let me put that on screen. Mark guidance and risk warning. Of importance, this lecture or tutorial is not oriented in any jurisdiction and is not intended for any use that would be contrary to local law or regulation of its users. It is the responsibility of the client to ascertain whether he or she is permitted to use the services of Global Accountancy Institute and Global Financial Engineering based on the legal requirements of his or her country of residence. I want to pause and ask you to read consciously the additional section of the risk warning. You could pause this video to do so, and then I will move the screen up for you to read the additional section. It's important to realize and to accept that as we go through these lectures, we'll be using some form of hypothetical trading that would seem very attractive. And while we use live data and some of the trades that we demonstrate in the lecture or in the videos or on the channel, you must remember past results are not necessarily indicative of future results. So I want to ask you to go through this carefully. Now I'm going to assume that you have done that. Or let me bring the final section to you. Again, you can pause the video. And go through it carefully. Hope you do that. You'll be at the bottom stage here now. And you will see the CFTC rule 4.41, which is relevant to us here in this lecture about hypothetical trade. Do that, and then we'll head over to our template, and we are using the global complete moving average trading system. in this lecture. Okay, so assume that you have done all of that. Let's head now over to our platform. And again, we are going to look at the GBP, Japanese yen, and for those of you who have get a little bit acquainted to these sessions, you'll have noticed that I normally pivot on the 8-4, which we call strategy 6. And just for the record, for the MT4 version, when you put the system on the 1 minute, we call that strategy 1. When you put it on the 5 minutes, you call it strategy 2. Put it in the 15 minutes, call it strategy 3. Put it in the 30 minutes, call it strategy 4. And the 1 hour, strategy 5. 4 hours, strategy 6. Daily, strategy 7. Weekly, strategy 8. And monthly, strategy 9. So at least you can reference, and each strategy come with a different risk model. We had worked out here at Global to come up with a uniform, a standard way to exit. And also we have a default risk management model where for system 1, strategy 1, you risk 0.01% of free equity. 2, 0.02. System 3 or strategy 3, 0.03. Strategy 4, 0.04. Strategy 5, 0.05. Strategy 6, 0.06. Strategy 7, 0.07. Strategy 8, 0.08. And strategy 9, 0.09. If you look, the objective is to get a framework that you will operate in, and that will allow you to be consistent. Hence, every trade have a name. So for example, when you execute trade from the daily up, that means you put the template on the daily time frame. This is known as a long-term trade. Okay? So daily up, long term. For the 4 hour, this is medium term. And for the 1 hour is a short term trade. And anything below the 1 hour, 30 minutes, 15.51, which means from strategy 1 to 4, these are what I call micro trend trades. Okay? Micro trend trades. So that's the framework in which we operate in, so as to remain consistent. So let me go back then to our pivot screen where we rest here, we sit here to make decision. Okay, so here I'm going to talk to you a bit. Okay? As a matter of fact, if we assume that we want to execute the 821 strategy, that the global 821, which is a crossover of the 8 and 21 EMA. On this time frame, the market structure here is bearish. But this crossover indicates to us that there is a high probability that price will rally back up to the 200. We would not want to take a buy based on this time frame, because if we take a buy based on this time frame, your risk will have to be 9 times the average true range of this time frame and 9 times the average true range of this time frame will come to about 580 pips, which is 9 times 0.6493. And if you do that, you will not be obeying the rule for buy for strategy number 6. However, seeing an 825 cross, you have a few options. You could drill down to the lower time frame, and since this 825 is an upward cross, where the 8 cross above the 21, I said 25. Some person sometimes want to use 25, some want to use 21. Personally, in most of my trades, I use 25. So my trade have been the 825. But the 821 is more common, so we decided to use it. You're not going to see much material difference, okay, with your trade. So let's reason. What you would have done, you want to take a bullish trade here, but you want to ensure that you conform to the plan. Where for bullish trade or for a buy, the moving average must be in a bullish market structure. That means we'll have to see this flip over. So you can start to drill down. And the 1 hour you would have seen it. Wow. Now you would have seen that this would be a little bit closer to the 825. Let me go and do this. Let me go and do this here. Let me put a vertical line here. I'm going to put it as a bowl. Let me skip it with the white. Okay? So the crossover will have occur here. If I drill down, I will notice that that crossover would have been equivalent to here. But when I look at the market structure here, the market structure could not be deemed to be bullish and orderly. But I'm still interested in the 821. So one option I could do, I could wait on system 5, or I could go down to system 4 and see what the structure gives me. In light of this, I would not be breaching, and let me take the outer score of this one. So if you want to go and identify that line, I'll just take outer score, okay, and therefore I can go back without the chart moving. When I come here though, I will also note at this point the 200 is on top of the 50 and the 100, while the 825 crossover, this was not yet a bullish market. I'm still interested in the 825. I believe in that 825 cross, so what I do, I drill down now then to strategy 3. And here you will have seen what the equivalent would have been at that vertical white line. I want to just see if I can go back and find it for you. Now, normally though, I don't like to take trade going back way down to the 15 minutes, especially when I realize that there's a potential for a reversal in the direction of the primary trend. So what I would prefer is to take it as a short-term trade. But if you want to take it as a micro-trend trade, that is fine, because what would have happened is that your stop loss would have been different from if you wait on the short term to take it where your stop loss is 292 pips instead. Okay, I want to put back this to an outer scroll, so it moves the chart back. Now, And this 1 hour, what you could do, you could wait for the moving averages to become more orderly. So for example, if you take the trade right here, right on this crossover, stay with me please, right on this crossover, I want to assume you take the trade right here. So let's say you take the trade, and let me put this to let me use Lemon Clifton for that. Then don't worry about what you are seeing here now, because this is where you'd have started from. Price would have rallied nicely above the 821. It pulled back into the 21, bounce again and rally. Go up here, pull back into the 21, rally. Pull back into 21, rally. But look what is happening here. This is an upward trend. Now, if you have taken that trade and you see a 821 cross here, you should exit the trade. This seems to be a gap. You should exit the trade. Should have exited the trade here, especially if we are into resistance like this. However, if you want to operate as a set and forget, all you have to do is to put 9 times the average true range as a trailing. When that happened, the price would have been trailing to the top, and if we assume that you are here, then 9 would have put your stop loss here. So what would have happened then? You'd have noticed that this little red dotted line, SL, it would have been above the entry, so you are locking in profit as the market rallies. While you would have put in the 9 ATR as a normal trailing, so it become a static trailing. In our advanced system, where the system automatically adjusts the stop loss based on the average true range during an expansion phase like this and contraction phase, the stop can be adjusted if we have consolidation. So when market consolidate, we expect the average true range to be less than the point at entry, and hence that will also move the stop closer. So you could trail by the 9 ATR and allow market volatility to take you out. And based on my experience and based on what we really want to achieve when we do system engineer, the less human intervention you can have in a system, the better it is. It will be more consistent. Hence, I prefer to allow my trailing to take me out. But maybe that is not your preference. We have discussed other methodologies that you can use to get out. We have discussed in earlier videos the fractal, where you can trail your stop. I want to do it here, following that methodology. Only that I want to put this to red to indicate stop. So you could put it below the tip of the fractal that falls below the 21, not above. So if a fractal is between the 8 and the 21, we don't consider it a valid fractal for stop. It must project, the tip must project beyond the 21. So the first valid fractal you could have would have been this one right here. It's project above it, and immediately you see your risk would have reduced. Then this fractal occur, you put it at the tip of this fractal. Now what happens is that you have now passed break even, and now you are now locking in profit. This little section is what we call secured unrealized profit. Then market rally nicely or pull back. We have a fractal here inside the 821. is not a valid point for stop, so you not trouble that. Then you rally again, and now you have one here. So you'd have moved this right here. Then another one, you move it. Another one here, you move it. Another one here, you move it. Now you'll have been stopped out automatically by this momentum to the downside, similar to when we had indicated that if you see that down cross, that cross to the downside and the magenta arrow turned down, you could get out. If you trail as indicated, it will also take you out in close proximity to that. So in this session, I show you the importance of sticking to your risk model. We believe that having an appropriate stop loss that allows your trade to move within corrective wave and not to stop out immediately, we have decided to use 9 ATR. And 9 ATR would have put the stop outside the market structure and also give you the ability to operate like a step as price moves in your direction. And at the same time, the objective is that if you have a losing trade, you will get out with less than 1 hour. Very important. We're going to talk about risk reward later in future videos. So this leads us to the end of today's session. We look at the GBP Japanese yen pair. We show you how you could get in if you are at your original platform here. Okay, of how you drill down. We're going to do many more of these series. So if you don't understand everything fully here, don't worry. The more you watch them, the more we will give you real time. And if you notice, we are not going back way in the 2004, 2018, 19. We are using real data within the current trading day to operate the strategy. It works. But yes, there are times, just as a time when you have hurricane, storm might be at sea. And if storm is at sea, the boat or the ship could be affected somehow in terms of its performance. But it doesn't mean that anything wrong with the boat or the ship. It's the same way for a trading system. Not all market conditions will be conducive to a trading system to make money. And that is why we need to have a proper risk management model in place so we can cut our losses short and allow our profit to run.